Good morning and welcome. My name is Elliot Refson and I lead the funds sector at Jersey Finance. Alongside working with industry and government regarding regulation, legislation and innovation, our role is to provide clarity on the vital role Jersey plays in international finance. In this session, our expert panel will focus on distribution, covering fund structuring, Brexit, and other political implications, as well as the impact of COVID on asset raising. Before handing over to our moderator for the session, if I may just spend a few moments putting our jurisdiction in perspective to frame the discussion. Jersey is an award-winning international finance centre whose reputation and regulation is acknowledged by independent assessment from some of the world's leading bodies, including the OECD, IMF, and World Bank. In the fourth quarter of 2019 and the first quarter of 2020, we commissioned a survey to look at the key trends in fund domiciliation. The report found the key issues, including Brexit, BEPS, substance, and transparency, have shot up the agenda when it comes to domiciliation decisions and are likely to influence decision-making for some years to come. The report also highlighted increased uncertainty, costs, and regulatory requirements in the Caribbean jurisdictions, and increased costs and reporting requirements in onshore European jurisdictions. However, the number one takeaway from this report is that investors, and it is investors who primarily determine domiciliation, want jurisdictions that can offer expertise and political and fiscal stability with a no-change outlook from a regulatory, legal, or economic perspective. Since the release of that report, and in response to the COVID pandemic, we have seen managers placing a new emphasis on contingency planning, looking at the physical infrastructure, the robustness and resilience of their fund domiciles. Further, they want to ensure that their service providers have the ability and the substance to support their needs in this new environment, and even whether they are physically undertaking the work within their jurisdiction. Jersey, having been an early adopter of international substance and transparency initiatives, has that respectability, it has that stability, and it has that no-change outlook supported by world-class infrastructure, highlighted, for example, by the second fastest broadband in the world and supported by broad and deep expertise from the nearly 14,000 people, or 44% of the working population, who work in the finance industry. One of our greatest strengths is the ability for our government, regulator, and industry to come together in a room to engage directly, address issues, and to innovate quickly and collaboratively within a robust and globally respected regulatory framework. This almost unique approach led to our opt-in, opt-out AIFMD stance, the Jersey private fund product, which can be regulated within 48 hours, our response to substance requirements, which were lauded by the OECD, and more recently, our resilient response to COVID, as well as the changes to our limited partnership laws to make it easier to port LPs from other jurisdictions to Jersey, and in the near future, our new LLC laws. One key element of our product offering that sets Jersey apart is our opt-in, opt-out approach to the EU Alternative Investment Fund Managers Directive, AIFMD. Being outside of the EU means Jersey is not subject to AIFMD when targeting investors from the rest of the world. Within the EU, Jersey has excellent, long-standing bilateral relationships with its member states and established market access arrangements via the national private placement regimes. These will not be impacted by Brexit. On the other side of the Brexit equation, Jersey's access to the UK is guaranteed under its private placement agreement there. To augment this, our regulator recently secured continued access to the UK in the event EU law no longer applies there, such as in the event of a no-deal Brexit. And in this way, Jersey bridges the gap between the EU and the UK in both a pre- and post-Brexit environment. But this is only a part of Jersey's flexible marketing proposition. By the EU's own statistics, only 3% of alternative investment fund managers are registered to market in more than 3 European jurisdictions. And that means that 97% of all managers do not market in more than 3 EU countries. If you are a part of the 3% who market on a pan-European basis, or to the retail market, then you will most likely need to access EU markets via another jurisdiction under the full scope of AIFMD or UCITS. But if you are one of the 97% who do not market so widely within the EU, then Jersey and its European private placement regimes offer a more cost-effective, a faster, and a more efficient solution outside of the full scope of AIFMD. And this is why there were more than 183 Jersey-registered managers opting to market into the EU through the national private placement regimes, a figure that's risen 76% since December 2015. This growth is underpinned in the strong support for the national private placement regimes highlighted in KPMG's recent pre-AIFMD2 report. Turning now to our panel, it gives me great pleasure to hand over to our moderator for this session, Niamh Lalore. Niamh is a partner and head of investment funds for OJ's Jersey office and head of the Jersey Funds Association Legal and Technical Committee. Niamh.
Thanks, Elliot, and good morning, everyone. So this morning we'd like to focus on distribution. Elliot mentioned that it's investors who typically choose the domicile. So it's our ability to effectively and efficiently distribute to those investors that's going to be key to the choice of domicile. So there's a few areas that we'd like to cover on together as a panel. We're going to set the scene with some structuring background. How do we set vehicles up? Legally, how do we market both into Europe and the wider world? We talked about political stability. Well, then we need to touch on Brexit, a post-Brexit world, and how that's going to impact marketing from Jersey. ESG is a very topical issue at the moment from an investor perspective, both when we're setting up a fund during the DD process, but also through the life of a fund and how that impacts reporting. And we'd like to talk about that a bit more. And then finally, how's the last 6 months been for our managers? What's the impact of COVID been on fundraising and the move to a virtual environment? So I'd like to introduce my panelists. We've got, on my right, Rob Milner. Rob is a partner at Carey Olsen. He acts for a wide range of boutique and institutional fund managers and has a particular expertise in establishing fund manager vehicles and their structures. Tom Powell, who's joining us remotely, is a local portfolio manager and a global head of investor relations at Kimura Capital. Tom works with a number of fund managers to generate sustainable investor returns. Giles Johnston-Scott manages Medici's Jersey operations and fund administration in Jersey. Medici is a life sciences venture capital firm that has raised 4 funds in Jersey in recent years, so you'll have a great insight for established managers fundraising from Jersey. We're also joined by Lewis Fellis. Lewis co-founded and managed one of the world's first regulated cryptocurrency hedge funds, Bletchley Park, and he successfully exited that during 2020. Lewis is currently building a new tech venture capital firm, Equi Global. So to kick us off, Rob, do you want to set the scene for us, talk about some structuring options and the legal ability for Jersey managers to market into Europe and elsewhere?
Yeah, of course. Thank you, Niamh. So as usual, I get the fun job. I have to make structuring and regulation sound as interesting as possible to the most number of people possible. And as usual, I sort of go away and I think, how am I going to do this? And make it memorable, make it involving. And so today I'm going to tell you a story about the Gazelle, about the eagle, and about a unicorn. Now, each of these represents a different type of regulation in Jersey, and then I'll explain how they come together and can be marketed to different places around the world. But to start with, in terms of pure structuring, in terms of vehicles available, Jersey has pretty much the smorgasbord of everything that you could possibly want. So we have cell companies, we have limited partnerships, we have incorporated limited partnerships, separate limited partnerships, unit trusts. Any vehicle you come across in most jurisdictions, or any key characteristics of any vehicle, are going to be available here. And frankly, we can just take that as a given. We keep working on our laws to keep them up to date, to ensure that the latest trends in international jurisprudence and litigation are reflected in our laws. So we're very confident that if you're worried about what sort of vehicle to choose, we've probably got it. So back to the story. So I'm going to focus on, say, the three most common types of regulatory structure we see. We also do, at one end of the spectrum, some very unregulated stuff, and at the other end of the spectrum, some very retail stuff. But the vast majority falls into one of three buckets. And I'll start with the Gazelle. So the Gazelle is the Jersey Private Fund. And this was set up a couple of years ago and represents a very proportionate approach by the Jersey regulator. Because they said, if you've got a small number of sophisticated investors, then we're going to devolve regulation to a large extent to a local regulated service provider who is going to help establish the vehicle, it's going to carry out due diligence on the people involved in it, and it's going to help with the reporting on an ongoing basis. So what are the key characteristics? So a Jersey private fund can be marketed to up to 50 investors, and those investors can be anywhere in the world. If they're in Europe, which we'll come on to, you can get the AIFMD overlay for this vehicle. Each of these investors has to be sophisticated or professional. So again, we're not focusing on retail here, but then the vast majority of managers who like to use Jersey have an institutional, sophisticated investor target base. So it works very well. And for this purposes, sophisticated means if you invest a minimum of 250,000 sterling, you automatically tick the box. You can invest a lower amount if you represent to the vehicle that your ordinary course of business involves buying, selling, managing assets. So you know, sort of fairly internationally recognized standard of sophistication there. Private fund can be set up within 48 hours. I mean, it's astonishingly quick. So, as I mentioned, the form filling is carried out by your local legal counsel and the administrator in Jersey. We file it online, and sometimes we get an almost instantaneous response, and a consent comes through very, very quickly, particularly if it's a second or third vehicle for the same manager. And so, I don't know, like a Gazelle, it's agile, it's quick, it's elegant, and it's working for an increasing number of managers as a way to getting to market in time frames and for cost amounts that are way, way below other comparable jurisdictions. And next up, we've got the Eagle. Now, what does the Eagle do? Well, it soars. It soars high and free, and that's what a public fund does. And we've got both listed and expert funds, which will enable managers to have an unlimited number of offers. So if you've got a much wider investor base, again, not necessarily retail, but the test for being an expert is slightly lower, and for listed, as long as anyone is professionally advised, they can come in. So you've got an unlimited number of offers available. Now, this necessarily involves a slightly higher level of regulation, the key part being that fewer exemptions are available for managers and investment advisors to these structures. So you are almost always required to be regulated to manage or advise a expert or listed fund. But once you've gone through some fairly basic due diligence on the part of the Commission, they ask for questionnaires for each of the directors, and the administrator assists in doing due diligence on the manager itself, then away you go. And the timetable for turnaround for an expert fund and listed fund is 3 working days. So you can have very quickly a public fund which you can then market to an unlimited number of investors. Again, very economic, very quick, and yeah, it soars like an eagle. And the final bucket we see, and again, this is increasingly popular, so it's worth talking about, is the unicorn. Now, unicorns are special and magical creatures, and what we've got in Jersey is a concept of things that just aren't funds. Now, you'll know if you work in the industry that virtually every jurisdiction prior to AIFMD and UCITS had its own concept of what constitutes a fund, and they didn't marry together very well. In Jersey, because of the natural predilection for sophisticated and expert investor structures, we actually have quite a narrow definition of what constitutes a fund. So things that might otherwise constitute AIFs or be treated as funds in other jurisdictions, in Jersey can be treated as either SPVs or joint ventures. And I call these a unicorn because there's no turnaround. I mean, you can set these things up virtually instantly. You've got huge flexibility in your structuring. So if you've got a co-invest, if you've got a carry vehicle, if you've got anything that represents a JV below fund level with a fund, anything, then if you tick the right boxes, from a Jersey perspective, you can be treated as a non-fund SPV or joint venture, which has been hugely popular recently because, again, a lot of managers are seeing great value in doing side deals with individual investors or by grouping individual investors for a single investment, both of which will qualify for this category. So we've got the three different types of animal, although there are others, as I say, at the retail and unregulated ends, but they all have in common is that they can be marketed with the correct consents into the EU EEA. And the way this works is by applying the Jersey AIFMD overlay. Now, as Elliot mentioned at the beginning, AIFMD does not have direct effect in Jersey. We're not in the EU or EEA. But what we've done is implemented our own national transposition of the law, and as you mentioned, it's opt-in. So the only bits that apply to you are the bits that need to apply if you're marketing into the EU or EEA. And those bits will depend upon whether you are managing sub-threshold or post-threshold amounts of capital and whether you're closed-ended or open-ended. As a broad guide, if you're managing up to 500 million euro with a closed-ended vehicle without leverage, then you have a very, very light touch. If you're managing up to 100 million of open-ended structure or with leverage, then you have that same light touch. But if you have above 100 million with an open-ended or leveraged structure, or above 500 million with a closed-ended unleveraged structure, then you have to comply with reporting, transparency, anti-asset stripping, and disclosure requirements of AIFMD, which themselves are actually quite limited. And it's mainly a reporting obligation on an ongoing basis that underpins that regime. So, as I say, it's incredibly flexible. You either market to the rest of the world, in which case Jersey structures sit alongside vehicles from everywhere else, because they're all third countries, or you market into the EU EEA, in which case you apply a straightforward overlay and obtain an additional couple of pieces of paper from the JFSC to enable you to benefit from the national private placement regimes into the various EU member states. And that's pretty much all I've got to say, Neve. So,
Thanks, Rob. That's really helpful and provides us with a good bit of background in terms of the flexibility. I mean, turning to you, Lewis, a lot of the flexibility Rob's just talked us through must be key to the decision you made to use Jersey for the domicile of your vehicles. What's it been like in the last 6 months? Because when you first chose Jersey, of course, you weren't aware of this move to a virtual environment for fundraising.
No, maybe not aware of it in the near term, but we certainly saw it was coming. It was quite clear that, people were going more online, and in some ways, the business trip to go on a very brief due diligence trip to meet a manager was probably towards the end of its lifetime. But to go back to your earlier point about choosing Jersey as a jurisdiction very early on. Originally, when I set up Bletchley Park, we knew that our investor base would be global, and so we needed to be in a jurisdiction that would embrace that ability to market globally. And so Jersey lined up very well for that. Where we are today, though, is trying to launch a venture capital fund in the very early stages in the middle of a COVID lockdown, or COVID pandemic, rather. And so that's throwing up some quite unique challenges. Originally, when we started looking at how do we market out of Jersey, the proximity to London and then onward flights made it quite easy. But as I said earlier, we knew that this was reaching the end of its life cycle. And so what we've had to focus on now is trying to understand the demographics or the people or the number of people willing to allocate without taking a face-to-face meeting. And there was a great report published by Eaton Partners, a fund placement agent, published on the 24th of September. And in their survey, they've said that 83% of respondents anticipated having no face-to-face meetings until next year, which for a new manager about to launch, that's a pretty daunting statistic. Especially when, from our perspective, we tend to think that that face-to-face meeting is a critical meeting as part of the due diligence process. And so that forced us to reflect on, how do we overcome this hurdle? And it wasn't all bad news. Within the same report, we found that 66% of the LPs can make an investment without the need of a face-to-face meeting. And so there is still a sufficiently broad base of investors that are available to market to. And so as a new manager, it becomes quite a challenge to create a high impact scenario when we meet these new people. Traditionally, when you walk into a meeting room or somebody comes to you, you can control a lot of the variables within that meeting. You can have a nice meeting room. You can ensure that we have good coffee. We can ensure that it's a comfortable venue. When we go into the virtual environment, the only thing we can control really is the content on our side. So it means having a very high production value, minimizing any disturbances. But what we found in testing, and so far we've yet to actually start marketing, but we are beginning to test our marketing materials with some focus audiences, is the focus audience itself is an unknown variable. And by an unknown variable, I mean the content, the medium by which they may be viewing your content. And so when we're marketing, if we're marketing to an LP sitting in an office with 2 large screens, that presentation is very different. You know, we can have a very engaging kind of almost face-to-face dialogue using a webcam, and then on the second screen we can have presentation material. However, when we go through the same presentation and we could be marketing to an LP sitting on a laptop or using an iPad, suddenly a lot of the content we've produced no longer carries across this medium. And so what we're now thinking of is, as we begin to initiate the dialogue and we move from an initial query via email or a referral, we're going to start asking questions about about their digital setup at home or in the office. And so we can actually begin to adjust our pitch materials to really have the most impact when we market to them. And I think that's going to become quite an important differentiator going forward.
Did you have a similar experience, Giles? Because I know you guys have been fundraising over the last few months, but it wasn't a first fund for you. So how had you found this move into a virtual environment, and then the old tools that Rob's laid out for us and the ability to market into Europe?
Yeah, so fundraising during lockdown has been pretty interesting. I think we're in a slightly different situation to yourselves. Obviously, we're an established fund manager, this being our 4th fund, which closed last month. But a very different experience, not so much, I guess, focused on the selling side and the tech side, but when you compare it to the previous fund, which closed, I think, in around January, February, Neve will probably know this, it was literally just before lockdown. And having spoken to the team, it was a very different process. There's probably made a note of 4 key takeaways from that whole process. Some won't be, that surprising, but the main ones are kind of a more efficient process. Less time spent travelling, like you were saying. That's probably coming to an end anyway, but certainly more efficient, both in terms of less international, domestic travel, more LP interaction, so actually more meetings than the previous fundraisers. And I'll go on to talk about that in a minute. And then a much bigger focus on DDQs, and I think that is probably purely down to COVID, particularly with BCPs. Investors want to see, how protected you are, how well you're looking after your team, how well you're looking after your assets during this time. And then fourthly, just on marketing, and going back to what Rob was saying in terms of how seamless really and useful the MPPR regime is, both just generally speaking, but also from a Jersey perspective. So with more efficient, obviously, is the less time lost on travel. The more meetings, not less meetings. This was a bit of a surprise, but when you compare it to kind of previous fundraisers where you would have, you'd spend 1 or 2 days of really intense meetings with LPs, dragging everyone into the room, from the kind of the guys right at the very top all the way through to the kind of compliance team, so they can cover off on key person interviews, operational due diligence, track record, etc. Pretty intense, quite time consuming, and then you flip that almost completely on its head during lockdown. We're able to have all of those meetings almost simultaneously, obviously, or virtually, but a series of selected, targeted meetings, so you can have the kind of compliance officer talking to the compliance officer, the right people talking to the right people, pretty much at the same time. So the process is condensed, and you're able to actually have more meetings, probably build up a little bit more of a relationship with your LP base than maybe you necessarily would. I know, from personal experience, you're kind of rolled in towards the end of the process to talk about the kind of the less exciting stuff. But actually, it's been quite useful to be involved in more of the other side of the fundraising process. On the DDQ side of things, I don't know if you touched on this, so to speak, but with COVID, obviously, being with us, we spent a lot of time, like most managers have, carrying out business risk assessments, and it's been, quite apt in terms of timing, because investors are looking at you whilst you're literally testing your BCP in a live environment. So there's been some, kind of interesting requests, and probably more detailed requests, I think, on that side of things, kind of, looking under the bonnet of the GP. How do you really operate when something like this kicks off. And that's at the GP level, but also at portfolio company level. We're a biotech VC, we invest in drug development. A really interesting time for drug development generally, but you can imagine the kinds of questions that might be asked now that more people are probably familiar with clinical trials and things like that. And then finally, just on the marketing point and using Jersey, we've done 4 funds in 5 years. We're a non-EU AIFM with non-EU AIFs, 3 of which have been marketed using the MPPR program. And I think, and Eve, you'll probably know this, but there's 1 or 2 jurisdictions where we are actively marketing, and we've carried out the notification requirements and complete the annual reports that go with those jurisdictions. And then the other jurisdictions, it tends to be reverse solicitation for the kind of more established LP relationships. But yeah, overall Jersey is, continues to be a pretty easy jurisdiction to sell, actually, for most of the reasons you were talking about. Our favourite animal is the eagle, as opposed to the other animals you mentioned. But yeah, overall, we had a positive experience in the fundraise during lockdown.
Giles, can I just jump in and ask a question? Given, as we've gone into this period where we're not seeing investments being made without, or a reduced amount of investments made with the face-to-face meetings not occurring, how have you seen a change in your LP base? Is it more follow-on offerings? Is it known LPs? Or are you still managing to attract new LPs during this time?
Yeah, so I think, we have a list of prospective investors that are not currently sitting in the books of the 4 funds that we look after. We're not top heavy in terms of number of investors. We've got some key relationships. So most of the investors that come into the recent fund are known to us quite well. But the interactions and conversations we've had with some of those LPs are that they do tend to be kind of retreating to the more well-known GPs. I guess for various reasons, COVID, economical reasons, political reasons, they're probably a bit more nervous with putting their cash with new relationships.
Yeah, so a flight to safety in some ways.
I think so. Yeah.
It's an interesting point in the DDQ, because I'm sure, like everyone else, has just seen the use of DDQs and investor-led research are going through the roof over the last 5-10 years. I mean, 10 years ago, I wouldn't have known what a DDQ was, bluntly. We never saw them. Nowadays, we get contacted all the time by potential investors in our clients asking us questions about our business and what we've done. And that's been a development. But the interesting thing you mentioned, and this is worth bringing out, is that when people are DDQing a fund vehicle and they see Jersey on the page as a jurisdiction of choice or domicile, they just say, yeah, fine, turn the page. It doesn't raise any questions. I mean, please tell me I'm right here, but do you ever get pushback from people saying, oh no, we wish you were somewhere else?
No, I think no is the short answer. We've had a couple of LPs, I think, with the following the OECD reviews on tax and eco-substance, etc. A couple of LPs that, I guess, firstly mandated to invest in Europe, so it's difficult for them to have to allocate monies to a Jersey-based fund manager. That being said, it still happens. I guess we're the exception to the rule, and they have to probably do a little bit more work internally, and we have to help them do that work in terms of the DDQ process and making sure that it ends up at the right level in terms of IC approval at investor level. So not so much pushback. There was, I guess, when Jersey was on the grey list. This is a while ago now. There was some talk about LPs building in like relocation clauses in the LPA and really just kind of hedging their bets ultimately to push the manager maybe over to somewhere like a Luxembourg or an Ireland. That didn't happen, thankfully. And so yeah, I agree. I think LPs are really familiar with Jersey. A lot of the biggest LPs in the world invest in funds that are operated in Jersey, and so it would be very unusual if they weren't quite familiar with our rules and regs.
Great, and it's worth noting that I'm sure Neve, you had the same experience. If you've got the European Investment Bank or European Bank for Reconstructed Development, they will naturally have a preference, as you say, for European vehicles, but they will come to Jersey vehicles. Yeah. And same we've seen.
Yeah, absolutely. I wanted to bring Tom in, actually. So, Tom, you advise a lot of managers on sustainable investing. How have you found you've had to adapt technology during the current environment?
Well, it's ironic that I join you remotely for this panel. It kind of highlights how it really is becoming the norm. The adaptation we had has really been to my benefit. My main office is in London. I've always been based in Jersey, and I've always been a promoter of the technology, and to echo what Lewis was saying, we could see that the tides were shifting. If you combine renewed scrutiny on costs alongside people's valuing times and work-life balance, and on top of that, ESG considerations with just hopping on flights all of the time, there was a clear shift, not only in the sentiment towards travel, but also the available solutions to get around it. And the fact that I'm joining you remotely here almost proves the point. In the quality of the tech, this isn't collapsing. I'm actually sitting in a pretty rural Herefordshire on a complete accidental trip that had to take place. And here we are participating in exactly the same way. And what this scenario is echoing is exactly how I work with my London office. We have a constant and seamless contact. There's a couple of points that have been raised there, and I think to Rob's point about the DDQ integrity and echoed by Giles, that has been one of the biggest things that has come under much greater scrutiny because people are relying less on their sense of feel or the whites of the eyes sense that they're getting from the managers. And to that end, we've seen way beyond the DDQ. We're using really very advanced drilling questions, questionnaires, what have you, from prospective consultants and investors that are looking at this. We've actually got a really positive story for Jersey through lockdown from a greenfield LP who I approached in the UK, so to prove the marketing element, with regards to potentially investing in one of our strategies. And we have done everything, and they are investing with us, and we have still not sat down face to face. Now that process has been slightly protracted in that we've been looking for the correct Gazelle, that we've selected a local SPV to put those in as effectively managed accounts. And the whole process has been carried out remotely. So there has been video calls, it has been individual compliance officer presentations, tailored presentations and what have you. But we've really been able to cover in a far greater granularity every element of the business without the stress of thinking, okay, this is your 6 hours in the office with the manager. You must ask all of those questions then and potentially have a couple of phone calls to tick the box. Instead, there has been a much deeper level of granularity throughout the whole due diligence process, which has been facilitated by the technology and enforced by the travel restrictions to create a better end product and a greater level of understanding between the LP and GP, which I think is going to lead to a lot longer term relationship in that they are still putting a lot of money with us and we are still very happy to be taking that, but they are doing it completely eyes wide open. I don't think there is any moment where it could be construed that there was a misunderstanding or anything like that. We are very comfortable in unilaterally that the level of DD that's gone on. And to that point, the Gazelle that we chose for this vehicle, it's a less liquid strategy. It is AIFMD compliant at the local level. So our Jersey manager is AIFMD compliant, managing an AIF. But for our London office, that manages a pari passu fund alongside it, they are not drawn into the regime by the way they operate. So that has been a brilliant separation that Jersey has offered us and enabled us to be a lot more dynamic. Interrupt me because I can't see your faces so well. So if there is anything dynamic here, but the main thing with the selection is that for a single investor, there is a very simple, very off-the-shelf solution to put some decent size money to work long term. Now, we can also flip that around and look at the liquid side. I actually moved to Jersey working with liquid strategies predominantly. And whilst illiquid is very much the bread and butter of the most of the industries here, the broader base of capital, actually liquid strategies work very well here. And working with listed derivative trading, CTA type funds, marketing globally, particularly where there is a penchant for managed accounts in that type of strategy, Jersey is fantastic. And that we grew up to $1.6 billion with investors spanning the globe. And that's something very much that's looking to achieve and repeat for not only my my current manager, but also other programs in there. I think it's probably worth noting the regulatory relationship as well from the JFSC, the local regulator. Strong connections with FINMA in Switzerland, made it transferring another manager I work with very easy to work both in Jersey and out of Switzerland. So it's not just for London and what have you that it works. My understanding is that it works for any manager from anywhere. And we can again go on to the Brexit briefing. It's strange sort of talking through. I'm not sure if this is being followed. Give me a sound. Just
on ESG, Tom, you were talking about the JFSC and your engagement with them. And I know there's a consultation paper out at the moment. How useful has it been for industry and the regulator to be able to have an open and a constructive dialogue about what regulation should apply in Jersey?
I think it's fantastic. I mean, I'm fortunate to sit as the head of the ESG working group on the Jersey Fund Association committee. And we had a very robust consultation with the regulator, and the fact that they come to industry, they have identified the fashion trend, or the demand from investors is moving toward more ESG focused product, and they want to ensure that the integrity of the vehicles that are being launched locally match the rest of the integrity of the island's businesses. So by coming to us and working very closely with the wider managers and financial services community here, we have been able to give a response to the regulator, which I think will give them really clear guidelines that not only reflect what the investors are looking to see, but also what the managers are looking to deliver, and how we're looking to market those. And the key point there is whether you're using ESG as a specific tool to market your vehicle, or whether you are merely adopting ESG principles in your day-to-day business. And where you are looking to promote specifically an ESG product, how compliant are there? Because we don't want to be in a scenario where those of us that hold the ESG principles very strongly to our investment criteria are being accused of greenwashing under an umbrella. So it's really reassuring that the regulator is consulting with industry to create parameters which not only facilitate but also clarify from an investor's perspective, this is the highest level of integrity in ESG.
Good point, actually, because certainly Giles and I have discussed this in the past in terms of ESG is not, although it's a buzzword at the moment, it's not a tick box exercise when fundraising, but of course it's going to impact reporting over the life of the fund. So have you found greater impact, Giles, from investors in terms of questions they're asking and how you're going to manage it over the whole life rather than just during the DD process?
Yeah, 100%. So I think, saying what was going back to what Tom was saying, the ESG questionnaires definitely more detailed than they used to be. No longer just like a yes/no type response to tick the box really. And it's a 10-year relationship with most investors. And I think if you were to take the approach of simply ticking the box to get the investment over the line, that's just not viable, not feasible. I also see, particularly on the last fundraise, we need to be able to kind of understandably explain our ESG policies. I think most fund managers have got ESG inherently built into what they do and how they do it. Good ESG is good kind of investment, but being able to explain that and then have a reporting framework that you can deliver to your LPs, I think that would be the bare minimum in the next kind of 12 to 18 months. So yeah, the DDQ process is actually helpful because it lets us know what LPs are looking for, both at point of investment, but also ongoing. It's obviously focused primarily on the type of investments that we're doing, the investment restrictions that sit around that, what we can and can't invest in. But more so, I think, and this is the learning curve probably for us, is reporting on ourselves as a GP. How do we operate our business? What are our policies on carbon footprint, diversity, recruitment, that kind of thing. They're more interested in that, I think, than they used to be. It's not so much about, are you going to make a good investment and give us some good returns?
So we've talked an awful lot around what investors are focusing on. Right at the beginning of this session, we talked about investors driving domiciles. And Rob, what are you seeing in terms of the focus on stability and the sort of no change environment that Jersey can offer?
Yeah, so obviously 2020 has been a bundle of laughs, which just keeps on giving. And we are seeing the fact that what we've developed over the last 30 years of being a sort of fund manager domicile of stability, transparency, and neutrality. In terms of stability, one of the most important things to note is that no matter what happens to Brexit, Jersey stays the same. We're already a third country from an EU perspective. Nothing will change. We're already a third country from a UK perspective. That might change for the better. So you can put yourself in a very strong sort of forward-looking position by considering Jersey structures in the context of Brexit. In terms of neutrality, again, it's not just, and this is an important thing to note, it's sort of a truth universally acknowledged that fund vehicles themselves should be transparent or neutral from a tax perspective. Virtually every jurisdiction has their own version of an efficient structure. But in Jersey, we extend that treatment to managers, and it's very important to note that this sits side by side with the substance requirements that have been introduced globally. Jersey finds itself in the frankly enviable position of being able to satisfy some of the most stringent substance requirements and have boots on the ground here and have things done from here when they need to be done, while maintaining tax neutrality at manager level. So if you've got a manager LP, all your individuals will get paid out gross and will then pay tax as it falls due in their home jurisdiction. If you've got a corporate, it'll be taxed at 0%. And again, so you pay it out gross, and the ultimate principals get taxed in their own hands, which by and large they massively prefer. And in terms of transparency, again, this goes hand in hand with the work that's been done over the last 20 years in particular in terms of Jersey's international relationships. And we adhere to the highest standards. And being a substance jurisdiction, being a transparent jurisdiction, is something that has been quite a lot of work for us. We chose to take this stand when other competitor jurisdictions were saying, no, don't worry about that, come here, it'll be easy. And now they are all having to scale up to get to our level, and they're not enjoying it. So we're seeing a real surge in both manager and fund structure relocations from other jurisdictions where historically, frankly, they hadn't got the standards that we've got. And because we've had them for so long, it's much easier to meet them here, and everything's designed around it.
So what about looking forward then? I mean, we've talked about lots of reasons why stability, access to market have worked for us, and we've been able to react as a jurisdiction to this move to a virtual environment. But as we all know, this is never static. So what should we be looking at as a jurisdiction in the future? What's the sort of the next thing? Lewis mentioned right at the outset that he could see the end to that constant stream of flights and meetings. What are you seeing now, Lewis? What's going to be the next thing as a jurisdiction that we should be thinking about?
I think, perhaps not as a jurisdiction, not to be that specific, but I think when we look at kind of the virtual meetings and we can see Tom there doing a grand job of being remote and participating, I think one thing that Jersey's been quite good at is a testbed for technology, and I think that new technology coming through is likely to see some form of augmented reality when we're presenting. We could be presenting in front of green screens, for example, which is we've in tests found that that's a great way to present when you have your pitch deck behind you and you can talk through it in a much more interactive way. And potentially virtual meetings, we could see that within the next 5 years. As a tech-orientated fund, we look at these technologies and it's not just about investing in them, it's how do we embrace them for the better to improve our business as well. And so to go through a DDQ process where maybe the LP is joining you via VR and they can actually see around your office and interact with the key principals, that could be a fantastic experience for them. Whilst I'm kind of talking about kind of the experience, I'd be interesting to hear Giles's kind of changes in the DDQ process. You talked that the teams are coming in for more meetings, they're more frequent. Have any kind of unexpected factors arisen from this DDQ process? And again, maybe this goes to Tom as well. Are there new standards within the DDQ coming out from kind of testing your BCP plan in real time?
That's a good question. I'd probably say no, to be honest with you, because we've been raising funds regularly in the last 5 years, so it's been more of a natural progression. Right. It's not been, there's been no big surprises in there. It's just been more detailed. They want to know a lot more about you as a house, about your portfolio companies, about, like I was saying before, business continuity plan seems to be one of the hot topics, in addition to ESG. And not just us either, so, talking about Jersey and opportunities for Jersey, ESG, I think, is definitely one of those for the administrators locally to really tap into and potentially help their client base in terms of obvious stuff, so reporting to the investor base, but also, what do they, what differentiates them as a service provider that might, attract more fund managers to go with them, as opposed to someone who's maybe less, ESG focused, so to speak.
Yeah.
But no real differences, I would say, from my personal experience.
Changes to DDQ, the AIMA standard has been bolstered, in particular around ESG. We've seen that really coming to the fore. And with the consultants, touching what Giles was saying there around the business continuation policies, there has been a lot of ad hoc, new, almost written on the wing, questioning that they've realised suddenly what does happen when no one can access the office. How reliant are you on your technology providers, on your Azure backups, what have you? So I think there is probably going to be a significant uptick in the questioning around specific areas, but it takes an event like this for those questions to even be considered and written. So I think we're probably in quite a state of flux around that drilling of that area at the moment as well.
Tom, do you think you could point to any kind of, or anticipate any industry standards coming out in terms of cloud hosting, percentage of the fund workforce being able to work remotely?
I don't know if there's going to be an industry standard. I think that it's more going to be investor-led when they realise that there are managers who have adopted, migrated, moved forward, don't have physical servers, what have you, aren't reliant on remoting into a desktop which has to be switched on in a physical office, and if there is a power cut then they have a problem because they can't access that. I think the more of the investors will be saying, are you sure that's necessarily how you would work? And what you tend to see is that it's demand led rather than manager pushed. So the cost of implementing a lot of these technologies, in my view, is high, and there are barriers. If you are a smaller size manager that set up sort of 5 years ago, you will not have the latest tech setup. You have to have a sort of can-do and adoptive, progressive IT and infrastructure mindset at a manager level, because otherwise you won't be passing the due diligence if you haven't got the latest levels of Azure remote access, the complete failover and 100% backup. I think remoting is a very much a dying way of doing it compared to the fully hosted solutions that are now available.
One of the consequences of exactly what you guys have been talking about is not just the decentralization of the investor-facing piece, there's the decentralization of the manager-facing piece. So what I've seen as people have been putting their business continuity plans into action is a realization. It's long been held in the liquids area in particular that actually you don't all have to be in the office. The actual decision making around the liquids can be taken on a very sort of regimented basis in certain jurisdictions, because that's how the offshore has worked for the last however long. But increasingly in active managers, you've got traders sat at home in their houses trading away quite happily. And the governance framework that needs to be put around that is not necessarily straightforward, but it's doable. And so if I'm getting my crystal ball out, I'm going to see a lot more managers decide not to go back to London. They're going to say, actually, I can quite happily do my job from pretty much anywhere. And this beach over here looks great. And but Jersey actually is a very strong contender for a place for relocation of principals and of key traders. And we've been seeing that in spades.
And how do you think our substance law is going to tie in with what you're saying, Rob?
It's great because we've already got the infrastructure here. So the ability to have a trader move over here and set up what we call a managed entity, which is an entity where the regulator, again, devolves a lot of the day-to-day to a regulated local administrator to make sure that all the compliance boxes are ticked and all the governance is proper. That's works really well. And again, because it's what we've been doing for so long, it's very easy to plug traders into that sort of structure. And away you go. And you can do it one of a number of ways. We've seen a series of different approaches depending on who the manager is and the seniority of the people moving over. But it's a massive trend, and it's going to continue because we are seeing a revolution in the way that people are approaching their work as a whole in Europe and the rest of the world, frankly. but Europe in particular, because this is where you have got the infrastructure that allows people to do things from virtually anywhere.
Yeah, I mean, it was meant fiber optic. In geek speak, my speed at home is up to 200 megs a second, which is just fantastic. It's probably faster than I'd get in my London office anyway. And the fact that you can trade, you can have access and what have you at such speed, whilst being part of the substance in the correct time zone and all of the rest of it, is part of the appeal for the institutional investors that we speak to and that are choosing Jersey to set up from. There is that element of accessibility. There is a business continuity works very seamlessly, particularly if you're a UK or European pension manager or senior sized investor. That solidity is very reassuring.
Okay. I think we've got about 8 or 10 minutes left, and we've covered a whole host of things, and questions have been flying in while you've been talking. So I'd like to take a few minutes to just run through some of those questions. Lewis was talking earlier about, okay, forward-looking jurisdiction, what do we do next? And our old favourite of KYC has come up. You know, what initiatives, Rob, do you want to take this one maybe as a point to take up with the regulator? What initiatives should we be looking at as a jurisdiction to make this seamless? Everything we've said today has been about ease for our investors. They'll choose the domiciles. How do we make that more seamless?
I see this as a sort of a two-pronged solution, and this is me, it may not be tomorrow's answer, but I very much hope in coming years this is what we're going to end up with. So what I'd like to see is a Jersey KYC passport. So you do your KYC once, it's held in a register that's endorsed by government, or run by government even. Again, it can take a number of different forms, but you end up with investors just having a one-stop shop. Their KYC is maintained, and that means they can do business with any other business in Jersey or any fund in Jersey. And that, to me, would be a massive step forward, because everyone knows and hates KYC. It's just friction wherever you go. We like to think that we've got sensible, proportional people in all local businesses, so as to make it as proportionate and as unonerous as possible. But the absolute magic bullet would be to say, here you go, this is what you need to do. You do it once and you maintain it, and that serves you for all Jersey businesses. And then you can get other jurisdictions to sign up to that. Because if there's a common standard, then you could end up effectively getting, as I say, a KYC passport, which would make me very happy. And then the next thing, which hopefully will follow from that, and this is my version of the I have a dream speech, although it's much less grand, I have a dream that one day investors will all have their own Jersey vehicles, because they will have a blessed passported Jersey vehicle from which to make investments. And that will mean that they can have access to investments all around the world. And you can have almost frictionless marketing, you can have frictionless management, and it would be an essential new part of our infrastructure. We always see it. I mean, for large institutions, they very frequently have aggregated vehicles or consolidation vehicles in jurisdictions like Jersey. And again, I feel that it would make everyone's life so much easier if they were to have a Jersey investment vehicle for making, for instance, non-EU investments. If you're an EU manager, then you've got the pick of the world's investments, you are unrestricted, and you've got flexibility and efficiency at every stage.
Thanks. So from the perspective of the managers then, having looked back on, let's say, the last 6 or 8 months, is there anything we as a jurisdiction, let's say, or you as managers, could or would have done differently? Hindsight being what it is. If you knew COVID was coming, is there anything we should have done differently?
I'd have got a better chair, actually, working from home. I mean, yes, it's a pretty difficult question. I mean, I love the idea of the KYC passport. I think that's been, spoken about for a while now. But I mean, it would be fantastic, be a great selling point for Jersey. So maybe I'd do that differently. We've got 45 LPs in the last fundraise, probably 150 across the book. It's a lot of limited partners, and a lot of those limited partners are already investing in, multiple Jersey funds. So it makes a lot of sense. So maybe that, I think, if it was available to use. Yeah, it's a good point.
Going back to what Tom had said earlier, actually, about industry and the regulator working together, maybe it's not such a pipe dream of Rob's then that we could move as a jurisdiction towards this if we work closely with the regulator and industry more widely.
Yeah, I think on my perspective, I think the electronic identification as just a first step ahead of that KYC passport, implementing that would just be a huge step forward for us.
And again, it's been a question of necessity because people have had to deal without wet ink certified copies and
Absolutely.
things. And so the regulators accepted that, and the regulator is now accepting documents which it would not have done a year ago. So again, this is a part of one of the positives out of the joy of 2020 is that it has pushed business in the direction it should have been going more quickly anyway.
Yep, we're proving it's possible.
Great. So you mentioned earlier, Rob, AIFMD 2, there's a review going on. Do we think the UK, this is $1 million question, do we think the UK is going to retain a prominent position in the funds world after that? Depending on your answer, how will that impact Jersey, do we think?
Oof, it's a very difficult question, but ultimately, and this is so important, the UK is the deepest pool of capital in Europe by an absolute mile. You know, it's got the institutions, it's got the professionals, it's got the sort of inertia that's very hard to shift, particularly as the EU dream would not be to have a single new European financial capital. It wouldn't be acceptable to the French if it's in Germany, it wouldn't be acceptable to the Germans if it's in France. So the model that the EU would advocate to try and drag the business out of London would involve the distribution of different professional services and different institutions around Europe, which is not what they want to do. They want to have a sort of a geographically focused product. And to me, ultimately, irrespective of the way that the Brexit negotiations go, the City of London will continue to be the key market in London simply because of that depth of liquidity. I mean, if you look at the actual stats, the other 2 or 3 key ones are Switzerland, which isn't in the EU anyway, and is diversifying actively from EU requirements. I mean, there's a lot of political tension there at the moment. And then there's Holland, which has its own peculiar issues. And again, it's becoming the focus of a lot of EU scrutiny as to the way that Dutch structures run at the moment. So I honestly feel that Jersey, in its position as a sort of symbiotic adjunct to UK, UK managers and capital trying to come in and out of the UK, or manage from the UK or Jersey, should be in a good place.
Great. Tom, any last thoughts from you? I'm aware you can't see the panel and we just have another minute or two. Any other parting comments you'd want to make?
No, I mean, we've touched on many of the areas that are really kind of key for us and key for our marketing efforts. The fact of the geography of Jersey itself, proximity to London, proximity to Europe, is self-evident, but also the time zone. I manage colleagues in Australia, Singapore, Switzerland, and then we do deals in the US. And the fact that we are bang in the middle of those time zones for our working day is just a massive happy boon. And the fact that there's all the substance here, the ability of the local workforce to be deployed into complex strategies with full understanding and full service around that is fantastic. So no, I just sort of tie up a couple of the pieces. The access to all of the world's time zones for business hours activity and the quality of substance that's here on the island.
Great. Thanks, Tom. Well, feels a fitting end, a truly global note. Thanks to all of the panel. I think it's been a really useful discussion. We've pulled together a lot of topical issues and had some interesting debate, which no doubt will continue. So thank you very much and good morning.